A price war between the big Canadian telecom players has been hard on some names in the sector. But with another earnings season just wrapping up, what's the outlook for the telcos going forward? Joining us now to discuss is Vince Valentini, Managing Director for Equity Research at TD Cowen. And for full disclosure on companies covered by the TD Cowen, please see the link to the website at the end of this video. And Vince, welcome to the show.
Great to be here, Anthony.
Now, we just got through earnings season, so let's go through some of the big themes that you saw, starting with the weakness in the wireless sector.
I think your timing of having me on is pretty good. I mean, telcos are obviously thought of as a defensive place to be. Still have some companies in this sector generating really good cash flow and paying good dividends. Interest rates and bond yields have come down. And I'd say for the most part, these companies have sort of stabilized what they're doing in fixing their balance sheets, or even the core wireless business I'll come to in a second. To your question, it's sort of starting to show some green shoots of turning around. So for people looking for some defensive sort of exposure to places to hide at times like this in a tough market day, certainly we're constructive on most of the names that we cover, including BCE, which every time I've been on this show in the past has been a name I haven't particularly liked. It's on our list now of names to consider as well. But specific to your question, sorry, not trying to duck it. Look, it was kind of a boring quarter overall. These companies are sort of sludging through what was known to be a pretty tough year in the sector. With the two headwinds, you pointed out the price war. The price war seems to be over. Thankfully, it seems like it's been over for 6 months, but there's a big lag effect of even customers that were added 6 or 12 months ago to Rogers, Bell, TELUS, any of the wireless carriers are still gradually working their way through the base and through the reported numbers. So they're all still fighting through a bit of a lag effect decline in their revenue per unit, or ARPU. And the other headwind is, as we know, the government has put full clamps on immigration and population growth, and therefore wireless subscriber growth has sort of fallen off a cliff this year versus what we had seen in the prior couple of years. But we knew that going into the quarter. There was nothing worse than expected. Nobody changed or lowered their revenue or EBITDA guidance for the year. So as I said, they're all sort of sludging through what was known to be a pretty tough year. If I give the positive, and some of these names, especially Rogers, have been acting, and Quebecor have been acting much better recently. The positive is the market, as it should be, is looking forward, not backwards. And what myself and most of the analysts and institutional investors are seeing is very nice steps towards better pricing discipline in wireless. And it's really across the board. You can't just say one carrier or another is doing it. Rogers, BCE, TELUS, and Quebecor all benefit from it, and they've all been pushing more disciplined pricing. Especially noticeable during the back-to-school period, which would have happened at the tail end of Q3. That normally you see some very aggressive pricing and promotions by all the carriers at that time. It's a bit of a slippery slope. We didn't see it this year. Everybody sort of held their ground and didn't get too crazy with their promotions. That hopefully is a good litmus test as to what to expect coming up very soon, which is the other big promotional period of the year, being Black Friday right through the sort of Christmas and Boxing Week period. The signals from the carriers are that they will maintain discipline. And Anthony, people are using that to look forward to say, okay, Q3 results were still pretty tough, but if this pricing trend continues, all these companies should be back to better year-over-year growth in ARPU by Q2, Q3 of next year, which means better revenue growth, therefore better profit growth, therefore more free cash flow to pay dividends or pay down debt. So I think there's a bit of optimism that the sector's turning after 2 years of tough price war. And again, I'll just circle that back. That combined with a bit of macro uncertainty and a bit of maybe the market's a bit overvalued in some places. I definitely would think that your listeners should have some of these telcos on their radar.
And when you talk about turnaround, one of the companies, as you mentioned at the top of the show, is Rogers. Why is that? Why is Rogers well positioned in this environment?
Yeah, we really like Rogers here, and I know it's up over 50% from its lows in May, but just as a reminder to people, it's still actually below where it was 2.5 years ago when they acquired Shaw. It was over $60 at that time. So we've gone full circle of stock getting almost cut in half to the low 30s, and now back to sort of the almost mid 50s, but it still doesn't make it overvalued in my mind. In fact, when we look at our valuation screen, it's now caught up to BCE. It's about the same valuation multiples as BCE, and still at a discount to TELUS. So first, it's not expensive, even though it's had a good bounce off the bottom. What is positioned well for Rogers going forward is they have I would argue, the most exposure to this recovery in wireless pricing. Technically, the percentage of revenue at Rogers is more wireless than any of the other names. The percentage of EBITDA is slightly higher for TELUS, but TELUS is viewed as a bit more of a diversified beast in terms of where the share price value comes from. They have a bunch of non-telecom businesses that they operate that have lower margins, so it distorts the percentage of EBITDA a little bit. If I look holistically at how most investors think about the space, they would think Rogers is the most exposed to wireless. So the turnaround in wireless that I articulated earlier, I think helps Rogers maybe a bit more than the other names. Two other factors for Rogers. One is they, after years of spending too much on capital expenditures and just not really getting much for it, it's not like they have some massive projects we can point to that would justify the money they were spending. They just seem to be a bit inefficient and not spending the time they needed to prioritize capital. Seems to be a big change in management and philosophy and execution there. They lowered their capital expenditure guidance concurrent with their third quarter results.
So
and
that
I think
should benefit the free cash flow.
absolutely. Free cash flow is going up. I think that trend is going to continue through 2026. So that's a good tailwind for Rogers. And last but not least, maybe there's another question on it, so I won't get into too much detail in my summary comment, but this sports phenomenon for them is just really just going from good to great as the value of the teams they own keeps going higher, and they're making much more clear that there is a path to monetization, including selling a large stake in their teams, MLSE and the Blue Jays, sometime in mid-2026. So that's a pretty exciting catalyst for the stock on top of a good core wireless business.
Now, you talked about Rogers having exposure, one of the biggest exposures to wireless. Is there a downside there? Because given the population growth is coming down, did you see any risks for Rogers in the horizon?
Well, sure, Anthony. I mean, I don't have to predict the future. I can just look at the past couple of years when wireless was falling off a cliff in terms of investor expectations and people were fearful of when we were in the worst of the price war. Rogers was the worst performing stock. There were maybe some other factors on top of that, including a bit of uncertainty about their balance sheet and what they were doing with all the sports assets. But the core thing was Rogers had the most exposure to wireless, and wireless looked horrible. Population growth, we've been knowing about population growth slowing for well over a year. So it was getting factored into street expectations and valuations, a long time ago. And the price war was very evident in results, 12 months ago. So Rogers has quickly swung from sort of worst because of their wireless exposure to best because of their wireless exposure. But to your point, if wireless somehow hit a wall, even in 2 weeks from now, if we see Black Friday promotions that are way more aggressive than anybody wants to see, and that scares people about sort of earnings estimates for 2026, then I would expect Rogers would probably get hit even harder than BC or TELUS just because of that outsized exposure to wireless. Specifically on population, I don't think it can get any worse than zero. When Canadian population growth is bouncing around zero, immigration is basically already on full restriction. The government has signals they're going to keep that in place, but I don't think it can get any worse than it already is. So if somebody had a theory that population growth was going to be minus 2 or 3% for the next 2 or 3 years, then yeah, maybe things getting worse for Rogers. But I think at zero, you've already washed things out in terms of expectations. They can't go much lower.
Okay, well, one of the things that's been in headlines, of course, as you know, is the opportunity in data centers, AI data centers. How do you see that playing out for the telcos here in Canada? Yeah,
so I didn't want to mention it's the biggest theme in the third quarter results, but it is a sort of very topical thing it's a term that's in vogue, and BC and TELUS are both leaning into that hard. Rogers and the other players like Quebecor and Cogeco really have no involvement and no interest. It's an enterprise business opportunity, and BC and TELUS have always been more the providers of telecom services to the big enterprises and government agencies. So they feel it's their core competency to divert some of their energy to actually building new AI, sovereign AI data centers in Canada. I'm a bit on the fence. I mean, at a high level, there's nothing wrong with it. There's obviously huge spending going into that area. Every government and big bank and other enterprise in Canada is indicating they're going to spend a lot of money on AI to try to get more efficient. So there's no doubt there'll be a lot of spending. And I have no doubt that BC and TELUS will be able to get some revenue and incremental profit out of these businesses. Where I'm a bit on the fence, Anthony, is Are they going to be the providers of choice for everybody? And that's really what you would need for this to become a home run, as opposed to just a nice little add-on to their business. It's not that material. For example, for Bell, they're targeting $400 million of revenue, 100 to 150 million of EBITDA by 2028. Not bad numbers, but relative to the entire size of the company, this is not moving the needle that big. If that 100 to 150 million became $1 billion, it starts to become a bigger factor for the stock. But to get to $1 billion, you have to have a view that not just the Canadian government, but virtually all big businesses in Canada are going to say, we demand that all of our data center compute and activity happens in a facility that is not only located in Canada, but it's owned by Canadians. When that's where I'm not sure that you can make that stretch just yet. I mean, I think Microsoft and Amazon and Google are going to make a pretty good case that, hey, we build a facility in Canada, we promise we're going to keep the data protected and you can have it there in a safe, secure way. The government may not go for that. The government signaled they want facilities that are owned by Canadians, but I'm not sure every Canadian company will feel the same way. I could be wrong on that, but that's my initial view, is this is a nice sort of source of upside for BC and TELUS, but not enough to fundamentally change how I think about the stocks.